Good morning, everyone. Luca Giangolini. I'm a partner at Capra Global Partners. We are a real estate specialist capital advisory business. What does that mean? We raise third-party equity for managers going into funds. We also arrange equity for joint ventures and debt for real estate transactions and funds. Just to summarise, we were formed in 2012 by my two partners. I joined in 2015. We've now grown to 13 people, and since 2015 we've arranged about €2.5 billion of debt and equity into real estate funds and transactions.
Great, thank you, Richard.
Hi, Richard Divall. So I head up the cross-border capital markets team for the EMEA region and a part of our global capital markets platform as well. I'm based in London, and Colliers, I hope most know, is a truly global advisory business. So we are getting to know the capital from around the world, connecting it to local partners, to local teams, to local listings that we may be selling. The Colliers business is on a big growth pattern, particularly to do with capital markets, where we're doing a lot of clever M&A deals around the region, adding some scale to our teams, filling in gaps on business service and sector lines that we may be missing, as well as recruiting some better grade people around the region for capital markets.
Great, thank you, Nick.
Nick Fox from Europa Capital. We're a just over 20-year-old business. We're still overwhelmingly known for our pan-European value-add fund series, but outside of that we are investing in UK debt and UK student housing currently, and we're beginning a core initiative with the collaboration with Mitsubishi, our major shareholder. I'm a partner in the business, a member of the investment committee, and I look after our German and French business in terms of the real estate coalface. We're about €3 billion under management, but with an €11 billion track record.
Great, John.
Good morning, everyone. I'm John Lurie. I'm the founder and managing partner of Realty Corporation. We are an independent real estate investor, operating partner and advisor with a number of people who have come out of Blackstone. And we invest in major asset classes across Europe, mostly in cities. We follow population trends, urban dynamics, and so forth. We also have a real estate advisory business that we recently combined with McKinsey, where we are I think the largest advisor to the major real estate LPs around the world, the US state pension systems, the Canadian retirement plans, and a number of Middle East sovereign wealth funds. We advise them on capital allocation, investment strategy and manager selection. And then we also spend time with the largest co-working company in the world and the largest shared rental services platform in the world, advising them on their real estate strategy. Pleasure to be here. Thank you, Richard, for organizing, and thank you very much, Colliers, for hosting.
Great, thanks, Eduardo.
Hi, I'm Eduardo Gorab. I'm an associate director at LaSalle Investment Management in the research and strategy team. Myself and Maddie McCrane are currently undergoing a project on global capital flows, trying to better understand the structural and cyclical factors that are best used to predict and understand these flows. LaSalle Investment Management is a truly global investment manager with just under $60 billion in AUM, with over 400 clients across all the corners of the globe. And we are primarily focused on long-term money from institutional investors, mostly pension funds, and we offer a wide range of products across separate accounts, commingled funds, as well as strategic partnerships. My main focus is around the UK, but as I mentioned earlier, I focus also on the role of global capital flows, particularly into the UK.
In terms of the capital flows, what are the sort of big changes that you've seen over, let's say, the past 12 months?
Yeah, I mean, I would actually look a little longer than that, in that it's really been a continuation of some really mega themes, if you like. I think we are starting to see, there's a continuation of an increased demand for debt investing into debt funds and actually direct lending as well. We've all heard how investors are looking for the kind of sheds and beds, which are driven by various demographic and internet-driven phenomenons. And I think we're also seeing some larger investors that are have generally invested in core real estate, being more willing to participate in development, kind of develop to core. And I think they're probably the main kind of high-level themes. Debt is attractive for a number of reasons, and I guess as we get later in the cycle, it's attractive because of its defensive nature. Build to core really just allows these core investors to access grade A stock and create grade A stock with a slight premium on the return. And Damien touched on many of the attractive dynamics as to why investors are looking at sheds and beds right across the residential sector, from student to PRS to senior living. So I think it's really a continuation and a picking up of some of the themes we've seen over the last 3 to 5 years, as some of the more core sectors have become potentially overinvested.
Okay, good. And Eduardo, just if we're looking, obviously you're on the research side, what are you seeing in terms of what you're forecasting, I suppose, or the trends that you're expecting to see if we look into 2019?
Well, I would largely echo the view that while there is a continuation of macro trends, there's also a slowing in certain aspects of those trends. The pricing side, obviously a constraint, but more than anything, we've noted that many of the core sources of capital flowing into Europe or flowing around globally, particularly from petro-dominated economies, has slowed quite significantly during this year, whether it be the UAE or Qatar or even Norway. We've seen very little in comparison to the sort of long-term averages that those sources of capital have been exporting really for real estate. And that in part is down to broader big picture economic forces like the slowdown of the mega commodity cycle, but also the fact that real estate opportunities are much more difficult to access in such a late cycle point.
Okay, good. And Nick, just pick up for me, if you will. You mentioned well known for opportunistic, but now launching core funds. What's driving that? Is that the desire of the capital that is looking for that kind of core opportunity?
Actually, I said value add, not opportunistic.
Sorry, value add. Yeah. Strike that from the record.
Definitions are blurred. I think there is a gradual trend generally towards value add, because I think whilst the yield gap is still very healthy, something like 4.8%, there is it's tougher to generate returns from core generally, unless you can buy into a growth story. So the core initiative that we're undertaking right now with Mitsubishi is very much looking at traditional core markets and sectors, but with a real growth story behind it to drive performance. I think, as Luca hinted earlier, it's otherwise very difficult to see where performance will come from the medium term, particularly in the very hot markets of Germany and Paris and even Amsterdam, which has re-emerged. But I think the movement towards value add is quite marked. I think that investors want to find enhanced returns. On the other hand, the kind of returns that are traditionally associated with value add and opportunistic, which in the traditional days were upper teens and double money, I think investors are accepting that they will accept lower returns. I mean, I think most of the capital raising that's going on out there in the value add space is suggesting 12 to 14%, even 11 to 13% net returns, and that's lower than is traditionally associated with the sector. And I think they'd like to do that based on taking a little less risk, because the danger, of course, in this apparently late cycle is that one stretches into too much risk to obtain these returns, and investors don't want to do that.
Okay, that's interesting. And John, in terms of your view, there's obviously a slight uptick in interest rates. Do you think that's a concern for global capital when they're looking at real estate, or do you think that there's still enough capital seeking a home that these kind of capital flows will continue?
Well, we've been calling it the Game of Thrones cycle, because for the last 5 years we've been saying winter is coming, and it hasn't quite arrived yet. But I think if you look at the US, where interest rates have gone up as a test case for Western Europe, the first thing to slide were the shares of REITs. And even though the US stock market just continues to hit high after high, the REITs have fallen far behind and are trading at massive discounts to NAV, particularly because people look at what is the 5-year swap and the cost of financing is going up and rents are not growing and they see the squeeze there and people get worried. In Europe, you're starting to see a little bit of that with the REITs trading off, although it hasn't quite happened here yet. The one thing that has, I think, saved Europe a little bit in global capital flows is we've seen this year an enormous inflow of private capital into real estate. In other words, the share, according to our figures, in 2018, we're going to see the share of the top 50 global LPs as a percentage of the overall real estate market decline for the first time in 10 years, meaning that the top 50 LPs, the US pension system, the Canadians, the Norwegians, the Middle East and Asian sovereign wealth funds will go down. And that share is being replaced by a lot of what's called high net worth wealthy individuals who are plonking $1 million, $2 million, $5 million into real estate feeder vehicles that are then investing in core plus funds, often open-ended core plus funds. And the amount of capital that's coming in from these smaller non-institutional investors is now outweighing the marginal flow of capital from the larger investors. So Europe, from a supply of capital perspective, is still being buoyed, but not by the traditional people. It's coming from new sources. And as an investor, you love it when new sources of capital are coming in because that means increased liquidity for the market. So I'm not as worried about the rise of interest rates in the US, in a rising interest rate environment in Europe, simply because this new capital that's coming in is not terribly interest rate sensitive and not terribly price sensitive.
Okay, good. And Richard, obviously you've been out visiting different sources of capital as well, both in terms of the direct, but also those who are operating through funds. What's your sense of some of the trends, and have you seen the same thing that John's talking about there, which is more of a rise of the private capital, of the high net worth?
No, I agree. I mean, we've seen very little activity from the traditional sovereign wealth funds. Obviously Knowles have just bought in London, which is probably the first one that's done something this year. What we're seeing more, obviously, in the direct side is a huge push from the Korean insurance companies into direct property. The Singaporean REITs, over the last 12 months, the Chinese have been very quiet, but they're starting to rear their heads and return. But I think you're going to see the Chinese in a different strategy. There'll be no more trophy football clubs or trophy hotels, and they'll be following the Chinese Premier's One Road, One Belt scheme. So I think logistics and business parks will come on vogue. And anything to do with senior living for the Chinese is going to be very important for them. But other countries that we're seeing starting to investigate Europe, the Australians, which Damien referred to, are starting to look. The Japanese are certainly making a noise, and there seems to be sort of second wave Canadian pension funds that are investigating as well. So there certainly is a lot of capital. There's a real lack of quality product. We're seeing lots of people focus on the alternatives and the logistics sectors. So anything from cradle to grave seems to appeal to a lot of the global capital. But I think some of the issues with the discussions I'm having with a lot of international capital is, wanting to partner up with the right people, and whether the right people. So for example, in student housing, have the big boys already come in and bought into the platforms that cover a national level or a pan-European level, and the other big boys wanting to get into those sort of sectors are struggling to find the developers, the operating partners that maybe can work on a national and regional level.
Okay, good. There's lots of questions coming in, and I'm just going through them, and I will bring those up. And also, if anybody doesn't want to use that and prefers to use the old-fashioned put your hand up or shout, feel free to also do that. I will also take all of those questions. Just picking up with you, Nick, I mean, Richard there mentioned Japanese capital, beginning to make noises, but in your particular case, it's slightly more than that. So just give us some insights on what you're expecting to see in terms of Japanese capital. Is this more of a long-term view on the market? Do you see this as Japanese capital creating inroads and then there's going to be more capital to come? What's your sense of it?
It's a lot of questions.
Sorry.
Yeah, first of all, I absolutely believe that this is a long-term trend. I think that, of course, we are seeing activity now. So in our case, well, I guess first of all, Mitsubishi via Rockefeller's acquisition of a majority share in our business 8 years ago was the beginning of diversification out of Japan. We have Japanese investors in each of our initiatives, in core, in value add, and in UK debt, and in student housing. So they're definitely there. One has to be very patient and measured in selling the story and selling oneself as the right manager, to Richard's point. But it's coming, and it'll come in enormous quantities eventually, and I think that will be something that we'll see a lot more of over the next 10 to 15 years, rather than necessarily the next 12 months.
Okay, good. And Luca, just pick up, if you will. Richard obviously mentioned some of the capital sources that are coming direct. In terms of the fund side, what are you seeing? Are you seeing new players coming in? Are you seeing the kind of swap over? I mean, it was interesting in Damien's presentation that the Australians were beginning to just pick up slightly as well there. What are you seeing?
I think in terms of fund investment, I mean, we focus most of our activity on Europe, but are also involved with North America and Asia Pac. I think the Japanese have started to invest in funds slowly. They did that a number of years ago. I wouldn't say that momentum's picked up hugely, but they are participating rather than hugely increasing their activity. The pensions and insurance companies around Europe have become increasingly active certainly over the last 5 years, and we're seeing a continuation of that. We're not seeing particularly any slowing down of that driven by concerns around interest rates or yields. Investors are still very active. I think if we're looking at inward investment into Europe, there is still capital coming in from North America. That's traditionally been at the higher end of the risk spectrum. I think as target returns, Nick touched on it, soften a little bit for value add and opportunistic strategies, we would expect to see a softening of North American capital coming into fund vehicles. They've tended to come across with the US managers who have been, they were smart money in the 2010, 11, 12. They spotted a market opportunity and they got a lot of traction with US LPs. We expect to see that story slowing down a little bit just as target returns fall. But certainly from European LPs, there's still strong demand, and I would say demand across the risk spectrum. There's demand for debt, there's demand for core, and also going up the risk curve as well.
Okay, good. I've got a couple of questions based around risk, and I'm going to try and bring those in. Eduardo, just in terms of corporate bond rates, which seems to be going up, what impact do you think that will have, if any? And also, do you want to just pick up a little bit on the interest rate question? One of the question that's just come in there is that will it necessarily, if economic growth is on a downturn, will that necessarily mean a swap in yields, or can yields go down further? What's that?
I think there's a balancing act there between the sort of policy bias of whether it be the Fed or the ECB, or as well as the MPC here, and the impact that may have on ultimately on property yields. While we do expect to see economies across the developed world at least slow somewhat over the next few years, there's no imminent risk of a recession, maybe outside of the US over the next maybe 3 or 4 years. So a spike in corporate borrowing costs seems relatively muted, and in that case, risks around tenants and the health of of occupiers doesn't seem all that at risk. With that in mind, I think there's a case to make that even with a gently rising interest rate environment, whether we're talking about policy rates or government bond yields or corporate bonds, the pressure on property yields could be relatively muted, in part due to continuing economic growth, but also due to the fact that generally speaking, supply cycles in real estate markets have been fairly controlled compared to previous cycles anyway.
Okay, good. And we've all been very, very polite, which is excellent, given that it's so early in the morning. But feel free to agree, disagree, come in on anybody else's question. That's absolutely fine. John, do you want to just pick up that point about the Chinese capital, what you're seeing, and also it would be interesting just to get your sense on the view of the capital raising, the equity raising side of it, given the background before with Blackstone, and just give us some insights on that.
Sure. Well, I would split the Chinese into two categories. The first are the government-affiliated institutions like SAFE, the Hong Kong Monetary Authority, which are extremely well organized, thoughtful, have a ton of capital, and just consistently invest year after year after year. And then on the other side, the private insurance companies, which are here today and gone tomorrow. There have been a number of examples of scandals and so forth in the news. They're interested in investing, they're not interested in investing. And I think if you have to look at them quite differently because they have very different investment approaches and very different capital allocation policies. Raising from the government-affiliated institutions is not an easy thing to do, but if you have a good story and you have a good track record, it's not incredibly problematic. Raising from the private insurance companies is a little bit more problematic, simply because their capital allocations are not necessarily fixed, and they vary greatly from year to year. I would say, speaking, maybe Blackstone is included in this group, in the large global fundraisers. Late in the cycle, it is incredibly difficult to promise somebody opportunistic returns. So if you're in the market now raising an opportunistic fund, you need to have a very, very good story about how that fund can be deployed. Maybe your story is, by the way, we're raising this capital now, and we might not call it for 3 years, and if the market slides, we'll come in and we'll start buying great properties at a discount to replacement costs, or buying things off the banks in exactly the same playbook that we did in 2011. But if you're looking to raise opportunistic capital now and to deploy it now, a lot of people have to tell stories that are a little bit harder to believe around alternative asset classes such as student housing, manufactured housing, co-working, areas where supply is still rather tight, although there's a lot of supply on the horizon, and rents are growing, but the question is, how far can they grow before the product becomes completely unaffordable to the people who actually occupy it?
Okay, good. I'm going to come to some of the sectors and drill down a little bit more detail into those. But just one thing, maybe Richard, with you, are you seeing anything on the risk side in terms of the difference between people looking at the UK, Brexit related, rather than Europe in terms of capital? Have people got used to the idea of that, or is there still a lot of concern over that in terms of a pause, or what are you seeing in the market?
I thought we've done quite well not to mention Brexit.
We have done quite well, yeah.
I think there's definitely more caution from the Europeans to do with Brexit. We've obviously seen DECA recently buy in London, but as a generalisation, the Germans or the French funds, going to IC to enter the UK at the moment is probably not as easy. Whereas when you go around the world, they just see it simply as, of course you're going to do a deal, it's not such a big issue for us. As we saw last year, a lot of Hong Kong money coming in, buying the trophy towers in London. We're seeing the Singaporean REITs aggressively go and buy business parks and logistics and student housing, etc. in the UK. So no, it's amazingly been very resilient, the UK, I think. There are certain people who are wary, but it's interesting when you go and speak to Canadian capital or Latin American capital, and because of the Trump effect over there, they actually do want to come over to Europe. So I think it kind of balances itself out. But as a summary, the global capital doesn't worry about it as much as probably the regional capital.
I would just echo that on the European LPs going into funds. I mean, we tend to work with kind of smaller niche strategies, raising 250 to maybe 750 million. So they do tend to be quite focused strategies. And the managers, well, speaking to the LPs around Europe, there just isn't an appetite to go into the UK given Brexit risk. And therefore those managers in the UK now are really not focused on raising funds until that Brexit risk has passed. Some are focusing on kind of separate accounts, maybe with the source of the capitals from outside of Europe, but really fundraising for UK fund strategies is almost entirely stopped.
Just to add, I echo that. Interesting that in our core strategy, for the moment, we've disregarded UK because we thought that was far too hard to sell.
Debt being exceptions.
Debt being exceptions, absolutely. But what I sense is that the North American community, and I mean including Canada, does definitely see the UK situation as an opportunity. So that's why I think we will see more appetite from North American LPs in value-add opportunistic strategies, because they are, I guess, far enough away from it not to get the scary Marys like the Europeans, but see it as an opportunity. To John's point, good luck asking an investor to commit and not deploy the money for 3 years. I don't like that very much in our experience, but I think they do see UK as an opportunity, and but it's down to the selection of the right opportunity and manager who they think can manage themselves through a rocky period.
I mean, interestingly, there's a question also come in, which is if it's a no-deal scenario for outside investors, does that also produce an opportunity? What's anybody's sense on that?
Well, I think for our part, really, whether I personally think we will do a deal. I just think that the EU team will come to the table and see sense. But I think even if we don't do a deal, I think the UK, look, it's Europe's largest, most sophisticated, most transparent, most dynamic economy. People are not going to stop investing in UK real estate. UK occupiers come to the UK for reasons way beyond its membership of the EU. It's about collaboration and languages and creativity and so on. So I think we are in for an unsteady year or two, and I think it'll impact on some sectors more than others. I think the City of London is in for a slightly rough ride for a short period, but London will bounce back.
Okay, good. Yeah, Richard.
No, I just want to add also, obviously it's the currency as well that's quite attractive to a lot of the global capital. So, when the pound sterling dropped 20%, a lot of the world looked that London's just got 20% cheaper. So, it's going to be interesting to track what happens to the currency over the next 6 months as well.
I was going to say I'm much less worried about the occupier market in London than I am about the investment market. So if you talk to people like Amazon, Facebook, Google, Deliveroo, Brexit doesn't really have an impact on their plans. In fact, they can't find enough people, and they're worried maybe their staffing numbers are too ambitious because they've got to get more people here. If you look at the continental European banks, I would be very worried if I owned an office building in the city that was 20% over-rented, that had a break option to a continental European bank in 2020. I mean, that's sort of the worst place to be. However, if you look at the job losses that have happened in financial services in London, or the forecasted job losses based on some jobs moving to Dublin or Paris or Luxembourg or whatever, and then you look at the job losses in the banking sector in Frankfurt, the German banking job losses are greater, and that's because Deutsche Bank and Commerzbank are cutting far more jobs in Germany than all of the banks combined in the UK. And that, I think, has zero to do with Brexit and more to do with things like fintech, where you have thousands of people sitting in office towers in Frankfurt or in Eschborn or whatever that are earning 50 grand a year processing trades, and all of these jobs are going to computer systems over the next 5 to 7 years. And the impact on employment, and we care very much about employment because that determines occupancy and rents, the impact on employment from the fintech phenomenon seems to be far greater than where we think Brexit is going to be in terms of impact on employment. No one really knows where that's going to be, but even in a worst case scenario where the city loses 15-20% of jobs, that is still nothing in comparison to the headcount. So that not necessarily how much does someone earn, are they a deal maker or a back office person, but headcount figures seem to be much more under pressure in the continent than they do in the UK at the moment. And I think that's sort of the untold story about what's happening in financial services occupancy in the UK and Europe.
Okay, that's interesting. And Eduardo, you mentioned that you were also at least half of your time focused on the UK. What's your sense of that? And also, do you think that if there's a drop in interest in London short term, is that also the same for regional cities or not?
So first off, I think I largely echo the sentiment that occupier markets seem on much better footing. And if that's the case, in the event of a no-deal type of Brexit, it would lead to some price dislocation, given that news flow, particularly political news flow, tends to move prices quite significantly, even when the fundamentals have not changed. The long-term structural advantages of the UK don't go away. It's about having a deep and broad capital and labor market that the UK has that makes it so attractive in relation to the rest of the globe, really. And in terms of regional cities, I think that the dynamics there are so much less intertwined with the potential loss of passporting rights, which is essentially the biggest risk facing office occupier markets anyway, at least in the UK, given that the regional markets are much less exposed to those types of risks. I see them being considerably more resilient, and the fact that pricing there is also much less stretched.
Okay, good. And this is really for anybody. Let's move away from the UK for a second and move into some of the European cities, regions. Any thoughts on Southern Europe? There's a question specifically on Southern Europe, but also we've got a CE summit coming up in November. So any positive thoughts about CE or negative thoughts are good, just in terms of how you're seeing that, and is the capital, their views matching what you're seeing in terms of your ideas on the opportunities for those locations? Anybody can pick any of those up.
For our part, Richard, we in our pan-European value-add funds, we like to put around 2/3 of our capital into UK, France and Germany, despite everything, as far as the UK is concerned. But the other markets, Southern Europe, Central Europe in particular, they're different. The cycles are slightly different, they're slightly shorter. The occupier dynamics are very different from the big Western European economies. And so we invest more tactically in those markets and very conscious of timing, because liquidity can evaporate very quickly in some of those markets. Where we do go into Central Europe, Southern Europe, we're overwhelmingly in the capital cities and overwhelmingly investing into product that we can create into a core thing that will have a wide audience. But timing is everything in those markets. Spain has recovered dramatically from a very low point. And is a very exciting dynamic market. For what it's worth, we're only at the moment looking at residential in Spain, on the back of urbanization, which is a theme that perhaps we might address at some point, but this is something driving our strategy. And to the residential point, which also applies to some other markets, Copenhagen would be another example, Berlin, Leipzig would be other examples. We are probably not untypical in that we are seeing a lot more residential opportunity and expecting to deploy capital much more in the residential sector than we ever have before. That said, we've gained entitlement or will gain entitlement for up to 10,000 housing units, and we will create 2,500 housing units across our last 3 funds across Europe. That's something that we probably wouldn't have imagined 10 years ago.
I would just add that in Southern Europe, there are 3 cities that have escaped the gravity of political dysfunction, high bond yields, and so forth. And those are Madrid, Barcelona, and Milan. And this week, many of you will know that the Italian government bond yield has increased in spread relative to Germany to levels not seen in years. But if you're a firm of 15 accountants looking for office space in Milan that has air conditioning and a lift, good luck. It doesn't exist. There's no supply. And we're seeing rents grow, particularly in office and in semi-urban residential, simply because of lack of supply. There has not been the bank financing in place over the last 7 years to deliver the quality of supply in the locations that people want to be in these 3 cities, and that's why you see prices tightening, even though the macro perspective for Italy, I would argue, is worse than it was at this point last year. You could make a similar argument for Spain with the noise around Catalonia, but I think the situation in Italy is worse. But if you're actually on the ground in Milan and you look at where pricing is, you don't see any of that macro noise impacting day-to-day occupier decisions.
Okay, good. Yep.
No, I was just going to add some positives for Central and Eastern Europe. I mean, I think transactions in the first half of this year in Poland have increased by 100%. And I think that's twofold. I mean, Nick's mentioned the liquidity issue that region has suffered in the past, but I think there's a great understanding now that I think over 40% of transactions in that region last year were done by local pension funds, so whether that's the Hungarians or the Czechs. And I think Poland going down the REIT route is sort of giving investors more confidence that they don't have to rely on a smaller window and international capital to exit, and hopefully it can go forward. But again, buying trophy assets in Warsaw at 5.25% plus is obviously attractive for a lot of investors who are being told they've got to pay 3% in Germany, Paris, and other key markets around the region. We get a lot of inquiries towards Spain, more so than Italy. I think Spain, like Ireland, they had to correct themselves the most. The fundamentals are good, but again, you have to pay 3% if you want a prime asset in Madrid, which looks expensive. I'm surprised when Draghi stopped the quantitative easing this year that it didn't have more effect on Southern Europe, really, but maybe that's to come.
And just in terms of CE, while we're on that, obviously a lot of South African money going to CE and SEE. Do you see that as continuing in terms of capital still wanting to diversify and come out of South Africa? Is that something that you're seeing, or are you expecting other investors to also focus on that region?
I feel there's been a slight pause with the South African capital. If anything, they might become more sellers, I think, in that region. But then they have the issue of where can I reinvest at high yields. It's all currency, political to do with South Africa. It's what's driven it out. It's them being overweight in their own market and trying to buy better quality income in Europe. So I would say over the last 9 months, yes, you hear of some groups buying in the UK. Yes, you hear of some groups still looking in Central and Eastern Europe. But I would say they're not making as big a noise as they were perhaps 12 months ago.
Okay, good. I've got a question for you in a minute, Jonathan, that I will read out. But Luca, just in terms of the fundraising, you mentioned difficult for some sort of funds. Are there any particular regions where it's very difficult or where it's changed? For example, I'm beginning to hear a little bit more about Greece, whereas nobody was talking about Greece 12 months ago. Still nobody talking about Russia or about Turkey, for example. What's your sense of that?
I think what we've probably noticed throughout this cycle over perhaps previous cycles is that LPs are tending to, later in the cycle, diversify more by sector than they are by geography. We're not hearing a huge amount in terms of LP investors' appetite for those markets. And where they are going into those markets, they're probably doing it directly or with a partner. That may be down to liquidity and exit risk, and when you've got a fund in Turkey or Russia or Southern Europe with a diverse group of LPs, and perhaps liquidity dries up, they're going to have very different objectives in terms of exiting, and I don't think we haven't seen a huge amount of fundraising in those markets for niche strategies. Now, of course, funds have participated in those markets. Again, you look at the opportunistic American funds. They've certainly been active in Southern Europe, focused on distressed markets and distressed debt. But we're not seeing any managers trying to raise niche funds in Southern Europe. Or where they are, they're not really getting, they're not large funds that are getting any particular traction from LPs in Europe.
Okay, good. A couple of quick, short ones for you, John. One of which isn't private capital more mercurial? You can answer that how you wish. But also linked to this is, are open-ended funds fit for purpose given their dispensity to close for high net worth individuals requiring daily pricing and daily liquidity?
Very few of the new funds being raised that are attracting private capital are priced daily. If you look at the private REIT market in the US, that's priced quarterly. And if you look at the shift from closed-ended funds that are doing core plus to open-ended funds doing core plus, the money is generational money. So if I'm a wealthy dentist and I have, let's say, $1 million to invest, I'm putting it there for generational reasons for my children. I'm not necessarily obsessed about where it is quarter to quarter. I might carry year to year, but I probably don't know the difference between buying London at a 5.25 cap and buying Paris at a 4.75 cap. I trust the manager and I pay the manager to make those decisions for me. And because this capital is a little bit more remote from the real estate world and is just looking at real estate as a diversification play, I think it's probably in it for the longer haul. Now, will we see a situation like we did in Germany where the open-ended funds, which take capital from people who are far less wealthy and are committing to the the new generation of core plus vehicles, will we see people panic and do mass withdrawals? Anything is possible. But the lessons learned and the way the open-ended funds were structured, to the way that, let's call it, open-ended fund 2.0 is structured, is the new fund rules make it much more difficult to have a run on the bank, in that the funds now need to, if you look at the term sheets for some of the capital that's being raised, rather than forcing withdrawals, the first thing the funds have to do is to stop accepting new deposits. The second thing that they have to do is to stop distributing income. And then, and only then, if there's say a 50% vote or a 75% vote of all the unit holders, do the funds actually start liquidating. And if you're thinking about polling retail investors about whether or not a fund should liquidate, good luck, because you bought the fund 3 years ago, then you get divorced, and maybe, do you own it? Does your wife own it? You die. Is it in your, did you put it in your will? Did you not put it in your will? Are you out hunting elephants in Africa and you're not actually answering the mailer from the bank where you're checking the box, do you want to liquidate it or not? So these funds have built in, I think very cleverly, poison pills to stop forced liquidations. Now, will they actually work? Nobody knows. But as a matter of contract, these new funds have all built-in insurance policies that if they have to hold on, they will hold on. And they all have leverage caps, so things have to get really, really bad for these funds to start spiraling into liquidation like the German open-ended funds did 8 years ago.
Okay, good, thanks. I'm going to zip through a few things now so that we're going to have plenty of time for networking and coffee afterwards. But let's have a quick look at the sectors. You introduced the topic of student housing, senior living, co-working. So just quickly for you, Eduardo, in terms of, there have been a couple of questions come in on senior living and on student housing. Student numbers going down, Damien mentioned, but also how do you see that? And also in terms of senior living, do you think there's opportunities for partnering potentially with governments, particularly here in the UK, because of the aims to solve issues like dementia and those kinds of areas? How do you see that?
In terms of the student housing story, we're not particularly upbeat on that, given that the government seems pretty unhappy to extend visa stays, particularly to overseas students. That's probably not a very attractive policy, particularly when you have countries like Australia or the US being much more lenient. If you're a foreign student and you want to come get a high-class education, you have other alternatives which are much more welcoming upon graduation. So in that sense, we're not particularly upbeat on the occupier side. And in terms of senior living, I mean, the big story there is demographic and you know, aging populations, etc. Will probably ensure that age-related ailments and health issues will continue to become more relevant as time passes. In terms of partnering with government, I mean, I'm not well versed in that, but I mean, I think that having a centralized control via BNHS is a clear advantage relative to in terms of providing a wide-ranging platform vis-a-vis a more diffuse system like in the US, for example.
I'm very negative on the long term on senior housing as a real estate investment.
Is this for you personally? That's not.
Yeah, I appreciate that the world is graying, and I appreciate that people need to downsize and move into these places. However, the amount of money that people can afford for their care, or the amount of money that a government will provide for care, will at some stage be capped out. And healthcare costs, so the costs of delivering the services, are rising quite rapidly. And so if you have a fixed budget to take care of someone, and the budget that you have allocated is for nursing or medication or whatever it is growing, where does the system squeeze? The system is going to squeeze on rents. And I think the amount of income that you're going to be able to get as a real estate investor in senior housing is going to be squeezed out by the rising cost of healthcare. And if you're a government and you have a choice between spending your marginal pound on pills and your marginal pound on rent, guess where the political pressure is going to go? So I have no issue with people who say that senior housing is chronically undersupplied and needs to grow dramatically. Where I do have an issue is where people are assuming that because there's such little supply in senior housing, that will translate into a long and sustained rental growth. I think that the pressure of the other costs of senior housing is a little bit about real estate, but elder care real estate is a very, very small part of that. And I think the political pressure on all of the other costs are going to cause governments to negotiate rent caps, just like they do in the social housing sector. And I think the income potential of senior housing from a real estate investment perspective is far more limited than people imagine.
Okay, good. It sounds as though there's going to be a bit of a crossover at some point between those in the Summer of Love in 1989 who are also thinking about, shall I spend it on pills or rent, and what they'll be doing later. Quick question from there, yes.
Yeah, I have a question about the economics of the build to rent. I see with competition for money going into the build to rent, the length of development periods, the competition to buy sites, that what is actually going to pop out are products that are too expensive for renters. So it may not address the housing issue, and it may not actually produce investment returns for investors. Is my perception on it. So I'd like to hear your views on what you see there.
I would agree with that. I think if you look at some of the PRS schemes that are going up, let's say within 2 miles of King's Cross, which is where it is sort of the epicenter in central London right now. A lot of these products are priced 10 to 15% above market, and people got comfortable with that because they thought, okay, well, we're going to provide amenities, we're going to have a gym, or we're going to have concierge services and so forth and so on. So you look across the street at the crappy Victorian walk-up, and you look at the beautiful new building. Of course, you would pay 10 to 15% more for the beautiful product. That is actually not proven out in the data just yet. And the product that is being delivered now, that was in planning 3 years ago, and that was where rents were priced 3 years ago, are obviously getting higher rents because rents have grown in that area. But if you look at the things that are in development right now and going up, if you look at where people are underwriting those rents, I would argue that that's going to be very difficult to obtain because rent is ultimately about affordability. And unless someone tells me that productivity growth in the UK is going to go through the roof, that salaries are going to go up, that wealthier people are going to move here and displace less wealthy people, which is probably the more credible of the three arguments. I don't really see the case for sustained rental growth in PRS. And I think there are going to be a number of people who are very disappointed with the returns on their investment if they're just projecting that rents are going to go into a step function as they have over the last 4 years.
I agree with some of that, most of that actually. But I think the key is build to rent to whom. And whilst the institutional market has come around to PRS, from an absence since the 1970s because it was a little bit close to human beings, I think the trouble is that they seem reluctant to get involved in the production of these housing units. So they're prepared to commit to purchase a fully rented, stabilized product, but they're not prepared to get involved in creating it. So for people like us, I hadn't intended to be blowing our trumpet again, but we are very much involved in facilitating the production of PRS. And we are not 20-year investors, we are 3 to 5 year investors. So typically we've been seeing opportunities where rents are very affordable, where rents will grow because of the lack of housing and because of urbanization trends, but we're taking a relatively short-term view. I think the question as to how sustainable this business model is going forward, I think will work itself out, as it has in Canada, in the Netherlands, in Germany, and in the US, where multifamily is very established. The market tends to work this stuff out.
Yeah, go ahead. Yeah.
Just quickly on that point, I mean, I think it's difficult to generalise, but certainly there will be opportunistic investors that are looking to develop residential schemes and charge premium rents that will be disappointed. But I think there's also some very core institutional money that's targeting much lower rate of return, and it's much longer term money, and is focusing on affordable land and therefore developing affordable PRS, which will not disappoint. It will not deliver particularly high returns, but I think the institutions are prepared for that.
Just very quickly on something that came up from the audience here, which is co-working, WeWork downgraded by Moody's, concerns about the rapid growth you could see in that chart in London, but also that what I'm seeing from across Europe, you're beginning to see WeWork and other solutions coming into place. Any concern at all that this actually isn't sustainable because the landlord doesn't seem to be making enough money out of it, or what's your sense on that? And the second one was on Airbnb. Again, we saw huge growth there, and the view I was getting when I was in Madrid recently was that if you're in Madrid, Barcelona, those areas where you're seeing those big growth areas, that actually it's beginning to be difficult to rent an apartment because the rents are going up because they're getting in line with Airbnb pricing, not with what it would be for a person to live and work there. But there's going to be more control from regulation. So those two sharing economy bits in a way, how do we see that? Do they really have big enough legs?
Well, being close to both companies, I would say that, let's start with Airbnb or their model more generally. I think the specter of regulation is huge, probably as big as on Airbnb as it is on Uber. Where if you look at what Kensington and Chelsea is doing about imposing 90-day limits on Airbnb, you look at what the city of Boston is doing, each municipality is coming up with its own citizen-led fight against Airbnb pricing everybody out. And I think Airbnb, they're very clever people and they will adapt to it. But the idea that you could build a building and rent the whole thing out as Airbnb, first of all, is against the culture of Airbnb. It's more like an extended stay hotel than it is sort of like a local immerse yourself into the city type play. But I think there is a role for the Airbnbs of the world in the modern economy. Cities are very expensive. People have expensive housing and can supplement their income by renting out when they're not using. That's a perfect solution, and I think it will stabilize at some point. I think the opportunity in co-working is much bigger, and co-working is actually, someone figured out a very simple answer to a very complicated question, which is no one wants to, who in the world wants to sign a 15 to 25-year lease on office space anymore? It's a long-term liability. Accounting rules move against it year after year. If you can find some flexible space, you're willing to pay a premium for the flexibility, and because you're shoving so many people into a small space that your cost per employee as a real estate matter actually falls on a per square foot basis, you can afford to pay a little bit more. And that's the arbitrage that WeWork and others have, is that, if you have your usual, hey, I'm a general office worker, I need 250 meters for myself. Actually, in the modern world, you don't. That's probably a little bit too much space. Everyone is cramming in a little bit. And if you can cram people in, but give them amazing services like yoga and fruit-flavored water and whatever it is they have, people don't actually mind that they're like, shoulder to shoulder with the person next to them. And I think that's why WeWork has been able to go literally from zero to the largest office tenant in London and the largest office tenant in New York, and they're continuing to open space. And if you look at their actual pipeline, not their pipeline on the development side, but their pipeline on the occupancy side, it's full. And so I think that has a lot of runway ahead of it.
Okay, yes, quickly, yeah.
Yeah, I mean, to touch on WeWork from an investor's point of view, we've seen in the past very limited interest in the odd Asian family office maybe buying an office with WeWork in London, but suddenly we're seeing the career insurance companies. They're buying number 1 Pulteney in the city. They're buying on Shaftesbury Avenue off Almacanter, and we've taken a career group who are very shortly exchanging on the WeWork in Dublin, and we're also selling a WeWork in Berlin, which is under offer to German money. But you can see that some investors are getting their heads around the credit of WeWork, and I know everyone's asking, how's it going to perform in a downturn, and they're all looking at the Regus model, but WeWork is very different to Regus. It's buying quality and renting quality real estate. It's not in secondary, tertiary locations like Regus may have done in the past. So it's going to be, it's interesting. I mean, it's harder to sell, but you're starting to see quite a lot of international investors get their heads around it. And there is a very well-known German bank that's providing debt on our one in Dublin. So even the bankers are starting to get their heads around it.
Okay, good. Final question to everybody so that we've got time for coffees and teas afterwards. I wasn't going to ask this on this occasion, but somebody has put it in, which is, so where would you invest? It's 100 million in this case. It's come from the audience, so we'll go with that, 100 million. And also just tell me what you think will be the biggest trend that we'll see in capital flows for 2019. Luca?
I think given where we are potentially in the cycle, I would say debt. Generally, and I would say, I'm not going to be geography specific, but I'd say, well, certainly in the UK, 0 to 70 whole loans look like they're on more transitional assets or against assets that the banks aren't willing to lend against, look like they're offering very good risk-adjusted returns.
Okay, Richard.
Yeah, I mean, again, I'm not going to go geographies, but I think anything to do with industrial and logistics, I know it's very expensive in certain markets, but I think there's so much room for rental growth and higher returns, etc. In that market. But I also think going forward over the next 12 months that it's certainly worth considering retail. I think we haven't really touched on retail today, but retail's had a hard time over the last 5 years, and if you go down, for example, the grocery supermarket route, which provides lots of indexation income, and these retailers have sorted out which are their core stores and which aren't, then it's offering attractive yields at sort of 6% plus. So maybe over the next 12 months, have a look at that.
Okay, good. Nick?
I'm going to spread my bets, funnily enough. So I'm going to go with Luca because I shouldn't I? We're working together in the UK debt. I would also go into urbanizing cities, both offices and residential, where there is still a real lack of quality accommodation, and particularly in the cities that have very strong underlying economies. And I would also reserve some capital for the UK, the regions in the short term, and London in the medium term.
Great, John.
I think the three things that I would put forth for the next year would be Southern Europe office to resi conversions. I think the price per square meter spread, there's a huge arbitrage there. The second I would say is something we haven't talked about today, which is Paris. I think I'm very, very bullish on rental growth in Paris, both on the office side and the residential side. And then the third thing is I would look for retail to reprice on a yield basis relative to logistics. Simply because we talk a lot about e-commerce and the growth of e-commerce, but if you look at some of the large retailers in Europe, such as Inditex, most of their logistics system is about serving their stores and not about serving direct parcels to home. And and while the amount of e-commerce done direct to home will likely grow over a period of time, I don't think it's going to get at a place where it totally eclipses the need to have a proper logistics infrastructure in place to serve stores.
Okay, good. Eduardo?
I would, without mentioning geographies once more, I would mention built-to-core offices, particularly in modestly supplied cities, particularly the bigger ones across Europe. And in terms of the biggest trend over the next 12 months, it would be the impact of that Japanese capital making its way over to Italy.
Okay, great. Thank you. Thank you.